Good evening. We begin tonight with a significant development in global financial markets as precious metals continue their extraordinary upward trajectory. Gold futures have surged to unprecedented levels, rising 3.7% to reach $5,270.40 per ounce during early market trading on Wednesday. Earlier in the morning session, the metal touched a record high of $5,306 per ounce, marking another milestone in what has become one of the most remarkable rallies in commodities markets in recent memory. Silver futures have similarly demonstrated substantial strength, rallying 6.5% to reach $112.82 per ounce during the same trading period. The movements in precious metals markets represent more than isolated price fluctuations. They reflect a continuation of trends that have been building momentum over an extended time frame. Gold has now increased 90% over the past 12 months, representing nearly a doubling in value for the yellow metal during this period. Silver has demonstrated even more dramatic gains, rising 265% during the same 12-month time frame. These percentage increases place both metals among the strongest performing assets across global markets over the past year, attracting attention from investors, analysts, and market observers worldwide. The price action on Wednesday follows gold's breakthrough above the $5,000 level earlier in the week. That psychological threshold, once considered distant by many market participants, has now been decisively crossed. The metal has not simply edged above this level, but has continued to advance, reaching the $5,300 mark during Wednesday's early morning trading session. This sustained upward movement indicates that the forces driving precious metals higher remain in place and continue to exert influence on market pricing. Silver's performance, while not reaching new all-time highs on Wednesday, nonetheless reflects significant strength. The price of $112.82 reached during Wednesday's session remains below the all-time high of $117.40 that the metal achieved on Monday. However, the 6.5% single-day gain demonstrates that buying interest in silver remains robust. The metal's ability to maintain levels above $110 after having risen 265% over 12 months suggests that the factors supporting silver prices continue to resonate with market participants. The relationship between precious metals prices and the United States dollar has emerged as a central theme in explaining recent market movements. Deutsche Bank strategist Henry Allen provided analysis on Wednesday, attributing the recent price movements to heightened geopolitical risk and what he characterized as a broader move away from the United States dollar. This analysis points to two distinct but related phenomena influencing precious metals markets. The first involves geopolitical concerns that typically drive investors toward assets perceived as safe havens during periods of uncertainty. The second involves a fundamental shift in currency positioning, with market participants reducing exposure to the dollar. The inverse relationship between precious metals prices and the dollar typically means that when the dollar weakens, precious metals become less expensive for holders of other currencies, thereby increasing demand and supporting higher prices. Conversely, when the dollar strengthens, precious metals become more expensive for international buyers, potentially dampening demand. This dynamic has been playing out in recent trading sessions, as the dollar has extended its decline while gold and silver have advanced to elevated levels. The United States Dollar Index, which tracks the greenback against a basket of 6 global currency peers, registered a decline of 0.1% during early Wednesday trading. This movement extended a recent pattern of weakness in the dollar that has coincided with strength in precious metals. The dollar's decline has brought the currency to levels not seen in nearly 4 years, representing a significant shift in foreign exchange markets. A near 4-year low for the dollar indicates that the current weakness extends beyond short-term fluctuations and may reflect more fundamental concerns about the currency's trajectory. Presidential comments regarding the dollar's value have added another dimension to market dynamics. President Donald Trump addressed the dollar's recent decline during an event in Clive, Iowa, on Tuesday. Speaking to reporters, the president expressed comfort with the recent decline in the dollar's value. He stated that he thinks it is great, referring to the value of the dollar, and pointed to business activity as evidence of the dollar's strength. The president's comment that the dollar is doing great came despite the currency's measurable decline against peer currencies, suggesting that the administration views a weaker dollar as compatible with or even supportive of broader economic objectives. The president's remarks represent a notable departure from traditional presidential communications regarding currency values. Historically, United States administrations have tended to express support for a strong dollar, viewing currency strength as a reflection of economic health and global confidence in American institutions. President Trump's explicit statement of comfort with a declining dollar therefore represents a shift in messaging that has captured attention across financial markets. The comments suggest that the current administration may view a weaker dollar as beneficial for certain economic goals, potentially including enhanced competitiveness for American exporters and support for domestic manufacturing. The impact of presidential comments on currency markets can be substantial, as market participants parse official statements for signals about policy direction and government priorities. In this instance, the president's comments came as the dollar was already experiencing weakness, and they may have reinforced the currency's downward trajectory by signaling that the administration would not take action to support the dollar or express concern about its decline. This dynamic has implications that extend beyond foreign exchange markets to encompass commodities, equities, and other asset classes, whose valuations are influenced by currency movements. The Federal Reserve's policy meeting, concluding on Wednesday, has emerged as a focal point for market participants attempting to assess the trajectory of both the dollar and precious metals prices. The central bank is widely expected to hold interest rates steady at the conclusion of its January policy meeting. This expectation reflects market assessments of current economic conditions, inflation trends, and the Federal Reserve's previous communications regarding its policy intentions. The decision to hold rates steady, if it materializes as expected, would represent a continuation of the Federal Reserve's recent approach to monetary policy. The relationship between Federal Reserve policy decisions and currency values is well established. Interest rate decisions influence currency valuations through multiple channels, including their impact on capital flows, inflation expectations, and relative returns available to international investors. When a central bank raises interest rates, it typically supports the currency by making assets denominated in that currency more attractive to investors seeking higher yields. Conversely, when a central bank lowers rates or maintains rates while other central banks adjust their policies, the currency may weaken as investors seek more attractive returns elsewhere. Chris Turner, global head of markets at ING, provided analysis suggesting that the Federal Reserve pausing interest rates could provide the dollar with some support. This assessment reflects the view that a decision to hold rates steady might be interpreted by markets as indicating that the Federal Reserve sees economic conditions that do not warrant further policy adjustments, potentially supporting confidence in the currency. However, Turner added an important qualification to this assessment, noting that if any rally in the dollar proved to be weak or if the dollar ended lower on the day, it would signal very bearish dollar momentum. This qualification highlights the uncertainty surrounding how markets will interpret and respond to the Federal Reserve's decision. Even an outcome that might typically be viewed as supportive of the dollar could fail to generate sustained strength if underlying bearish sentiment remains powerful. The dollar's inability to rally meaningfully following a rate decision that would normally support the currency would send a signal about the depth and persistence of the current weakness. Such a development would suggest that factors beyond monetary policy are driving dollar weakness, and that these factors continue to outweigh traditional supports for the currency. The potential implications of the Federal Reserve decision for precious metals prices are substantial. As a weak dollar has supported the precious metals rally, any shift in dollar dynamics resulting from the Federal Reserve announcement could influence the trajectory of gold and silver prices. If the Federal Reserve's decision and accompanying communications support the dollar, precious metals could face pressure as the inverse relationship between the dollar and commodities reasserts itself. Conversely, if the dollar continues to weaken despite the Federal Reserve's decision, precious metals could find additional support and continue their advance. Market participants are therefore focused not only on the Federal Reserve's rate decision itself, but also on the broader communication from the central bank. The statement released following the policy meeting, along with any press conference remarks from Federal Reserve officials, will be scrutinized for insights into the central bank's assessment of economic conditions, inflation trends, and future policy intentions. Any signals regarding the Federal Reserve's independence, its assessment of geopolitical risks, or its concerns about dollar weakness could influence how markets interpret the decision and respond in subsequent trading. The context in which this Federal Reserve meeting is taking place adds additional layers of significance. The meeting occurs as gold has reached $5,300 per ounce, as silver has risen 265% over 12 months, and as the dollar has declined to near four-year lows. It also takes place following presidential comments expressing comfort with dollar weakness and amid what Deutsche Bank has characterized as heightened geopolitical risk. These circumstances create an environment in which the Federal Reserve's decision and communications may have outsized impact on market direction. The concept of heightened geopolitical risk, referenced by Deutsche Bank's strategist, encompasses multiple potential concerns that may be influencing investor behavior. Geopolitical risk can stem from international tensions, conflicts, policy uncertainties, or events that create uncertainty about future conditions. When geopolitical risk is elevated, investors often seek assets perceived as safe havens, meaning assets that are expected to retain value or appreciate during periods of turmoil. Gold has historically served this function, viewed as a store of value that exists outside the system of government-issued currencies and maintains purchasing power across different political and economic environments. The characterization of a broader move away from the United States dollar suggests a trend that extends beyond short-term trading positions. Such a move might reflect concerns about various factors, including fiscal policy, monetary policy, political stability, institutional integrity, or the dollar's role in the international monetary system. When market participants move away from a currency in a sustained fashion, they typically reallocate capital to other currencies or to assets that serve as alternatives to currency, including precious metals. This reallocation can become self-reinforcing, as initial movements create momentum that attracts additional participants. The magnitude of gains in precious metals over the past 12 months places current price levels in historical perspective. Gold's 90% increase represents a near doubling of value, taking the metal from levels around $2,750 per ounce a year ago to current levels above $5,200. This rate of appreciation exceeds what would typically be expected based on inflation, economic growth, or other fundamental factors, suggesting that extraordinary circumstances are driving demand. The outsized gains indicate that investors are placing significant value on the perceived safety and stability that gold provides. Silver's 265% gain over 12 months is even more dramatic in percentage terms. This increase has taken silver from levels around $30 per ounce a year ago to current levels above $110. Silver's percentage gain exceeding that of gold reflects several dynamics. Silver is a smaller market than gold in total value terms, meaning that flows of capital into the metal can create larger percentage price movements. Silver also serves dual roles as both a precious metal with investment demand and an industrial metal used in manufacturing, electronics, and other applications. The current rally appears to reflect strong demand across both dimensions of silver's market. The record high reached by gold earlier Wednesday morning at $5,306 per ounce represents a nominal peak for the metal. This level surpasses all previous prices recorded throughout gold's trading history. Each successive record high for gold attracts attention and can influence market psychology, as investors who may have been waiting for a pullback observe the metal continuing to advance. The ability of gold to establish new records repeatedly within a short time frame suggests that the forces supporting higher prices remain intact and continue to outweigh any profit-taking or concerns about elevated valuations. Silver's recent high of $117.40 reached on Monday similarly represents an extraordinary level for the metal. While Wednesday's trading kept silver below this Monday peak, the metal's ability to trade above $110 and post gains of 6.5% demonstrates continued strength. The fact that silver reached $117.40 on Monday, just 2 days before Wednesday's session, indicates that the metal's advance has been particularly concentrated in recent trading. This rapid appreciation can create both opportunity and risk, as sharp moves in either direction become more likely when markets are trending strongly. The early morning timing of gold's record high reached at $5,306 before pulling back to $5,270.40, illustrates the volatility present in precious metals markets. Intraday swings of this magnitude, representing moves of $35.60 or approximately 0.7%, occur when markets are highly active and participants are actively adjusting positions. Such volatility is characteristic of markets experiencing strong trends, as bulls and bears battle over price direction and short-term traders enter and exit positions rapidly. The market environment heading into Wednesday's Federal Reserve decision reflects multiple cross-currents. On one hand, precious metals have demonstrated extraordinary strength, rising to record or near-record levels on the back of dollar weakness and elevated geopolitical concerns. On the other hand, the Federal Reserve's policy decision could potentially alter dynamics if it provides support to the dollar or if the central bank's communications shift market expectations. Market participants must weigh these competing factors in determining how to position for the remainder of Wednesday's trading and beyond. The inverse relationship between precious metals prices and the dollar, noted by Deutsche Bank's Allen, has functioned as expected during recent trading. As the dollar has weakened, gold and silver have strengthened. This relationship is rooted in multiple factors, including the fact that a weaker dollar makes precious metals less expensive for buyers using other currencies, the role of precious metals as an alternative to the dollar as a store of value, and the tendency for dollar weakness to correlate with conditions that favor safe haven assets. The consistency of this relationship during the current episode reinforces its importance as a framework for understanding precious metals price movements. The characterization of the precious metals rally as seemingly unstoppable, while reflecting the strength of recent price action, also carries implications for market psychology. When markets are described in such terms, it can influence participant behavior in various ways. Some investors may be drawn to participate in what appears to be a powerful trend, creating additional buying pressure. Others may become concerned about overvaluation or unsustainable momentum, leading them to reduce positions or avoid entry. Still others may seek to position for an eventual reversal, attempting to profit from a decline. The interplay among these different participant groups contributes to market dynamics. As we examine this developing story in the hours ahead, several key factors will determine whether precious metals continue their advance or face a period of consolidation or correction. The Federal Reserve's decision and communications will provide the first major test, with potential to either support or undermine the dollar and thereby influence precious metals in the opposite direction. Any additional comments from administration officials regarding currency policy or economic conditions could similarly affect market sentiment. Geopolitical developments, should they occur, would likely factor into investor assessment of safe haven needs, and the technical dynamics of the precious metals markets themselves, including levels of speculative positioning and potential profit-taking after such substantial gains, will influence near-term price action. The broader context for understanding current precious metals prices includes recognition of the sustained nature of recent gains. The 12-month time frame over which gold has risen 90% and silver has increased 265% represents more than a short-term spike. This duration suggests that underlying factors supporting higher prices have persisted and evolved, rather than representing a temporary shock that quickly fades. Sustained rallies of this magnitude typically reflect fundamental shifts in supply and demand dynamics, changes in macroeconomic conditions, or alterations in investor preferences and risk assessment. We will continue to follow this story closely as events unfold throughout the trading day, monitoring the Federal Reserve's announcement, market reactions to that announcement, and any developments that might influence the trajectory of precious metals, prices, and the dollar. The coming hours will provide important information about whether the recent trends continue or whether a shift in dynamics emerges that alters the current market narrative.